In this video, I want to talk about some trades for the next week that's coming up, and I'm looking at the financials sector. It's been pretty weak over the last couple of weeks, but my prognosis shows that there may be some strength in the market with regards to the financials. So I'm looking at some bullish plays for the next couple of weeks. But first, let's just quickly go over some of the trades that we have on or have closed just over the last couple of days. So we already spoke about Amazon. We had a pretty nice trade where we just needed Amazon to stay above a certain level. You can see that Amazon's been going up since we got into this particular trade. So that's been pretty good for our position. We haven't been able to benefit this entire move to the upside, but certainly we benefited as Amazon moved up and reached our target. We kept that credit that we had put on. We kept that credit that we had received for putting on this trade. So it's a great trade. Now, I already mentioned to you Deckers. It's done exactly as the prognosis from our last couple of trades. You can see we entered when the stock was starting to move up. I spoke about this yellow line, which represented the 50-day moving average. You can see that the stock hit that yellow line as expected, and since then it's just been coming down, and my prognosis would be that it will either hold at this current level, which is very important, this very important support level at $60, or the stock would continue going down and test back somewhere here at the 200-day moving average, which is just above 55, so maybe around that $56 mark. And then we will look to get into this position again and reforecast the next move. Okay, so we got out basically somewhere around the $64 mark, which was where I was expecting the stock to go, back from somewhere around here. Okay, so that was a good trade. Now, I don't think I spoke about Twilio, so I'll just ignore that. I didn't speak about the Qs, so we can ignore that. Google, we do have a trade on Google. You can see since the trade was put on, Google's simply been going sideways. It's stayed above its 50-day moving average, this yellow line, so still worth a shot. And if I bring up the trade on the platform, we needed Google to get up around that $800 mark. So you can see we had already risked slightly lower than my traditional investment amount of $1,000. And that was because I remember when we were setting up this trade, I said that I was going to set up this trade such that it was an all-in trade, meaning I wasn't going to manage the trade at all. I was just going to leave it on, and it would either move to the upside and hit our target, in which case we would make roughly that 945, or it would not move up, either go sideways or come back down, and we would lose whatever we had invested. And therefore I only invested a certain amount, a lower amount than I wouldn't have normally, because I wasn't going to manage the trade. Or I should say, this is the way that I'm managing the trade. I'm leaving it all in. And so you can see I'm nearly losing all of that amount that we had invested, although we've still got another week or so in the trade. So we've got 7 days. So I think Google has been weak. It hasn't been able to get above this $780 mark. It's found some serious resistance at that level, but I think it's still holding its 50-day moving average, and so there could still be some room for it to move to the upside, but highly unlikely. But we'll continue this trade and manage it in accordance with our plan, which is to leave the trade on until we either lose the entire amount of $555, which was our investment and maximum risk, or we actually hit our target of $800 and actually walk away with a nice profit of $945. Okay, so we'll see how this goes. We've got a week remaining in this trade, so we'll monitor it, and I'll pick it up maybe somewhere around Wednesday or Thursday and let you know what's going on with Google. Now, I also posted a video on the euro currency. You can see we got in somewhere around here where this arrow is a couple of days ago, maybe about a week ago. And you can see it's still trading within that wedge. So we're really looking for a breakout above the the wedge or below this wedge for us to actually continue to see any signs of a profit. Okay, and that's why it's important that when you set up this particular trade for this specific setup, you make sure you have enough time, which is why I said you need to buy options that are around 60 to 90 days until options expiry, okay, so that they don't decay too quickly, because you don't know how long you're going to be in this trade. Even when the trade works out, you need to give the instrument enough time to do its thing. So usually this sort of trade, you might stick within the wedge for around about a week or two, okay, and then probably around about a week or two while the stock is actually moving in a particular direction, okay? So we'll continue to monitor the euro as well. At the moment, we're still in, and I don't think I spoke about Priceline. I do have a trade on Priceline. I got in somewhere where that arrow is, and it's sort of moving up slightly, so I'll just move forward without talking about that. So what's this one here? This is Google again, I think. You can see that Google is also coming into that sort of a wedge, okay, where I spoke about when I was talking about the euro trade. This is a similar pattern that Google's now forming, which is you have a bit of resistance at the top here at 790, and you also have a trend line to the upside, and you can see Google sort of stuck in this little wedge here, or this triangle formation, and it's going to move up and break out, or it's going to move down and break down. So it's going to move in one way or the other. So there's certainly a bit of tension building up there with Google. Okay, for our trading Google, we are expecting, or what we want Google to do is to move to that $800 mark. Okay, but of course we could be wrong, and that's why we had only invested a certain amount, and in this case we were risking that whole amount that we had invested. Okay, now Apple, I am looking at Apple. I'm just waiting for Apple to come back down closer to that 110 mark, which is where I'm going to look for my re-entry. Or if it starts to break up above this 115 from here, I'll also start to look for a re-entry. If you remember, we got into Apple, I don't know exactly when, but there was a trade, I think somewhere around here, under this, actually it was somewhere around, actually I can't remember, I'll have to go back and have a look, but we did have an Apple trade on a couple of weeks ago. I did post a video about it and it did well, and now I'm looking to re-enter for a new Apple position, but I'll keep you posted. It hasn't really come to fruition just yet. Now, as I said, I'm looking at the banking sector. So the first one I want to talk about is Bank of America. I really like this pattern where the stock's moved up and it's had a bit of a pullback. I measured what this pullback is, and I think it's around about 40%. So the stock has pulled back around 40% of this move up. And I really like this trend line to the upside. Now you can ignore all of my moving averages that I have here. I've just put on a couple of moving averages to see the overall pattern of which way the stock is moving. But the key point to note here is that the stock, on its last close, had a pretty big move to the upside with some fairly decent volume. Okay, you can see here down the bottom there's some fairly decent volume on that day, which was last Friday, the 30th of September. And you can see it closed above all of these moving averages. So to me, that's a fairly bullish signal with its high volume, with this fairly strong move to the upside. And I'm setting a target of around just above this $16.50 mark. So around about that $16.60. Now, the options that I've chosen for this particular case study, let's have a look. It is the 15 call option that expires in just 3 weeks, okay? So it expires in 21 days. Now, if I scroll down, this particular option doubles in value at a very tiny 6.7% move in the underlying stock. In this case, it's Bank of America. Now you can see that occurs when the stock price is around that 16.60 mark, which is exactly where I believe this stock is actually headed towards. Okay. Now, of course, I could be wrong. So Let me mark on the chart where I don't want to be in this trade is the stock trades back below these levels, and that's going to be around about this $15 mark, okay, which is below all of my key moving averages, okay. So if the stock is trading below this $15 mark, then I'm going to look to get out of this trade and cut my losses, okay. Now, what does that mean for our position? How much are we going to actually be losing if the stock trades back down below that $15 mark? Well, we need to go to the risk graph and calculate how much money that would be so that we know what our potential risk is going to be as we manage this trade, okay? So if I go back to the risk graph and I look at where $15 is on this chart, there's $15 here. Look on this left-hand side, which is where the stock price is, and this bottom sort of horizontal axis is the profit. So you can see if the stock goes below $15, well, we're going to lose around about that $500-600, okay, which is around about that 50% of my current investment, okay. So that's in line with my management plan. I manage my trades to a 50% less, okay, a 50% loss, I should say. So I'm going to stay in this trade so long as the stock remains above this stop loss level, which is below $15, okay? Or if the trade hits my target, which is around that $16.60 mark, okay? That's what I'm looking for this particular stock. Now, you can see here that it says earnings is coming out in 17 days, okay? So I need to be careful and decide for myself if I'm going to stay in this trade throughout earnings, okay? Earnings could have a massive impact on the position and the stock could move in any particular direction. So I might decide that I want to get out of this position before that earnings report is released, okay? So I'll talk more about that as we get closer to earnings. Okay, so that's our trade for Bank of America. I've also discussed how I'm going to manage that trade for a 50% loss. Now, I'm also looking at Citigroup. Citigroup is making a similar, or has a similar chart pattern. Okay, so you can see it's also moved up. It's a bit choppy, I would say. If we look at Bank of America, the chart was it's actually a very nice, clean looking chart, where Citicorp was a little bit more choppy, okay? Just pull back down here and a few more smaller pullbacks. But overall, I do like this chart pattern. Now, you can also see that with this pullback, the current price of the stock, which is here, is above all of these key moving averages, which I haven't really spoken much about, but I will talk more about moving averages in the next couple of weeks with additional videos. I'll try and do a video on technical chart analysis, which will allow me to dive a little bit deeper into what moving averages are all about and how I use them. So last Friday's trade, you can see the stock closed fairly strong on high volume as well. So you can see volume is actually fairly good with this stock as well, Citigroup in this case. And we had a nice close above all of these key moving averages. So to me, that's a fairly strong bullish indication that the stock's got some potential to continue to move higher. Now, I've drawn some lines here, some horizontal lines. Now, these are basically 3 different options expiry periods. So you've got the October options, and you've got the November options, and you have the December options. Now, what I was trying to do here is to try and calculate where I believe the stock is headed towards based on the current movement. If the stock were to move in the current trend, then I just wanted to see what sort of timeline I needed to think about, and then what sort of target would the stock sort of be reaching towards. Now, I sort of worked out that the stock's headed towards that $50 mark, and I calculated and forecast that the stock would get to that level somewhere around towards that end of November, between November options, okay? Now, of course, I could be wrong. I'll talk about how I'm going to manage this trade to limit my losses, but let's have a look at which option I've actually gone with for Citigroup. So I see 42.50 call. Okay, and I've bought enough contracts to put in what I normally invest, which is around about $1,000. And in this particular case, as I said, I've bought the November options, which gives me around about 50 days to be in this trade. Now, if I scroll down and look at what the platform says, then you can see here that my double occurs with a tiny 11.6% move in the underlying stock, which means the stock needs to move up to around about that $50 mark, or 52.72 to be precise, for this position to double. Okay, so it's in line with my prognosis. The only thing I don't like about this is that the stock needs to move more than 10%. I like to have a double when the stock only has to move less than 10%, but no problems. I will stick with this trade. We'll monitor this trade. Now, of course, I could be wrong, as I've said before. So where on the chart do I not want to be in this position if the stock starts to trade back below a certain level? Now, for me, I think the key support level is around this $46 mark, okay? So I don't want to see this stock trade back below this $46 mark, which is also right at its 50-day moving average, okay? I might let it go a little bit lower than 46, but not too far, maybe 45.5 or somewhere around that level. But basically my stop loss level is I don't want to see the stock trade back below this $46 mark. So if we look at the risk graph, let's have a look at what is the potential loss that we might incur should the stock trade back below 46. So you can see here's 45, so I'm happy to manage this trade up to 44.82. So I'm allowing the stock to trade back below 45 to give the stock a bit more room to move around, okay, before I take the trade off for a potential loss. So I'm risking again. As a management plan, I'm willing to give up 50% of my entry, okay, which is a risk of $500, a potential loss of $500, to allow this stock to move around. But if the stock closes below that $45 mark, well, then I'm going to exit the trade for the loss of $500. Okay, so that's how I'm going to be managing Citigroup. Now I want to show you another stock that I looked at, which is also in the financial sector, but I didn't go with this particular trade. I want to talk about why. Okay, so let's have a look at KeyCorp. So KeyCorp, you can see, is of a very similar pattern, just like Bank of America and just like Citigroup. However, if I zoom in, you can see it didn't have the type of close above the moving averages. Look at where the last close was on Friday. It is below, if I just get an arrow and mark it so you can see, here's where the close is, okay? Now, it's closing above the 50-day moving average, but below some of my other moving averages, okay? If I look and I show you Bank of America, the close is above all of my moving averages. I'll put an arrow there so you know exactly where the close is. It's right there, okay? Now, you could wait, I could wait another day to get confirmation and only get in at a next higher close. That sort of gives you further indication or another confirmation, but it's every individual trader's own personality on how they want to enter their trade, what makes them comfortable with the trade. For me, this is enough, okay? Now, if I go back to what I was talking about with KeyCorp, you can see that it hasn't really cleared some of those moving averages that are higher than the current price of the stock, and they're going to act as a barrier, a bit of resistance. So that's why I didn't enter this particular position, even though it has a very similar pattern, just like Bank of America. And if we look at Citigroup, then you can see it has a very similar pattern, but it also has closed above all of its key moving averages. In fact, Citigroup's pattern towards this sort of entry is a lot stronger in my view than Bank of America, even though its chart was a bit choppy back here in August. But it's clearly strong on Friday above all these key moving averages. So I really like this setup as an entry. But as I said, every individual trader has their own personality on how they like to enter their stocks and what they look for as indicators to give them a sense of comfort that they are right in their thinking. But of course, we can all, and we as I said, I can always be wrong. and therefore I need to manage this trade accordingly. And I've spoken already about how I'm going to manage these trades and where my stop loss limits are. Now, I also want to talk about in this video Netflix. So let's have a look at Netflix, okay? Because I like to have a couple of positions in the opposite direction. So the last couple of positions that I've spoken about, so Bank of America and Citigroup, are all positions that are bullish, meaning that I'm going to profit as the stock moves up. Okay, so they're bullish positions. Now, I'm looking for a couple of positions that I can put on to the downside, okay, because I like to have positions in both directions of the market. Now, I still need to find a few better positions to the downside, but I looked at Netflix and I thought to myself, Netflix has a lot of resistance. If I draw a trend line here, and I believe that the stock will struggle moving higher, and not just because right now Netflix is at a very key trend line resistance level, but if you look at current resistance, this $100 mark, not only is it a psychological resistance level where stocks generally find it difficult to get past, but it's had 4 times it's sort of bounced back down from these levels. So I think based on this chart, one could say, well, Netflix is certainly finding some resistance at the current levels of 100. So I thought to myself, how could I, as a options trader, benefit with this sort of prognosis where I don't believe the stock's going to get above 100 anytime soon? So the trade that I looked at for Netflix, if I can find it here, is I sold some call options. So I sold the 100 call, and I sold the 100 call for $157, and I sold 10 of those. So I brought in whatever money I brought in, over $1,000 probably. And sorry, yeah, that's actually, so I brought in $1,570. Okay, if they were, because I sold each contract for $157. So then, for a bit of protection, so that I wouldn't have unlimited risk, I then bought the 102 call for 80 cents. So I had to spend, out of that $1,570, I had to spend $800 to buy some protection, and that gave me a credit of around about $770. Okay, now my total risk in this trade is $1,230. That's the maximum amount that I can lose on this particular trade. Now let me show you the risk graph, because that's where you're going to understand what I'm trying to do. Because I've sold a call option, okay, essentially what I'm doing here is I'm giving somebody else the option to buy Netflix at $100. Okay, so for Netflix, let's look at the stock chart. I'm giving someone, because I've sold the 100 call, here's the 100. Here's 100 on the stock price. Okay, that's right here. You can see the stock is very close to 100. In fact, it closed at 98.55 last Friday. Now, by selling the 100 call, I've given somebody else the right to buy Netflix at $100. So therefore, my objective is for Netflix to actually remain below $100. Okay, if Netflix does that, then that call option that I have sold this person, this 100 call, will actually expire worthless, and that means I can keep all of that credit that I had received. Okay, now it will expire worthless because why would somebody exercise an option that allows them to buy a stock at $100 when they can actually buy the stock lower than $100 because the stock is below $100? Okay, so that's why that option actually becomes worthless. And anyone that sold it, in this case, I've actually sold it, I have created and written this option into the market, well, then I receive a credit, some money, some income for that, and I get to keep that so long as Netflix remains below $100. Okay, that's how that works. It's a bit more of an advanced strategy, but it means you don't really have to have a target. Okay, this is the same sort of position that I did on Amazon, where Amazon had to stay above a certain level. In this case, I'm doing it in an opposite way. When we looked at Amazon, we sold puts. Okay, so we gave someone else a right to sell Amazon at a certain level with the expectation Amazon is going to trade higher. Okay, therefore making the put option worthless because that person who bought that put option could sell the stock at a much higher level, and therefore why would they actually exercise the put option, which was at a lower strike? Okay, go back to the Amazon video to understand exactly what I'm trying to say, and maybe then as I'm talking about this now, listen to what I'm saying, but look at the Amazon chart when you understand what that Amazon trade was all about. With Netflix, I'm doing the opposite. I'm selling call options because my expectation is that Netflix is going to stay below a certain level, and that level is $100 on the stock chart, because I can see, as I've explained, that there's a bit of resistance at this level. So I don't believe that Netflix is going to go higher. Okay? Of course, I could be wrong. And that's why when I'm selling the call option, I need to also buy some call options so that if Netflix does go higher, okay, then if you understand what I've done, I have sold someone a call option, which means I've given someone else the right to buy Netflix, okay? That means I have to sell Netflix to that person at $100, okay? Now, if I have to sell Netflix to somebody else at a price of $100, well, then I need to be able to buy Netflix at a certain price. And that's why I myself have got a 102 call. So somebody else has sold me a 102 call, giving me the right to buy Netflix at 102, and I will be then forced to sell it to the person who bought my $100 call to that person at 100, meaning I would take a loss of $2 per share. Okay, so that's how this works. But we don't have to get too worried about what happens in the stock market. We are only trading options. Okay, so all we need to know is what's our maximum risk for our options trade, and in this case, it's $1,230. Okay, if I didn't buy the 102 call to offset my risk in selling this 100 call, then I would have unlimited risk. Okay, you need to think about this slowly. Maybe take some notes as I'm talking you through this. If I have sold a 100 call, that means I've given somebody else the right to buy Netflix at 100. Now, if all of a sudden Netflix is trading at 110, right, that means I have to sell somebody Netflix at $100. Okay, now if I don't have Netflix shares, I have to buy them at the current market price. And if the market's at 110, well, then I have to buy them at $110 and sell it to the person I sold the call to at $100. Okay, it's a $10 per share loss. That's why I have purchased a 102 call at the same time that I've sold a 100 call, so that if Netflix does go up, okay, which is not in line with my prognosis, then I simply have a limited $2 loss per share. Okay, now, as I said, all you need to worry about is this particular transaction here. We've bought some calls for protection, but our ultimate goal here is to sell calls, and that's what we've done. We've sold the 100 call because I don't believe Netflix will go over 100. Of course, as I said, I could be wrong, and therefore we need to manage the trade accordingly. Now, where on the chart or where on this risk graph am I going to manage this trade to? Well, I don't want to see the stock trading above $100, okay? Because my expectation is it's not going to go above 100 and it's going to remain below this trend line. So if the stock goes above 100, let's say 102 for example, well then I'm going to be closing this trade for a potential loss. And we need to work out what is that potential loss. Well, if I put my cursor here at 102, that loss is going to be somewhere around $500, okay? Which is in line with what I expect, okay? So I'm willing to lose $500 to potentially gain $770. Okay, this is a slightly more advanced strategy. As I said, I've mentioned this before, but don't trade this strategy unless you really understand the risks that you have. This risk of $1,230 is your theoretical risk. You will lose $1,230 if this trade doesn't go to plan. Okay, I'm going to try and manage this trade such that if the stock closes above $102, in this case the Netflix, well then I'm going to try and exit this trade, and I will take a loss of around about that $500 to $600. Okay, so we'll see how this goes. So that's it, guys. That's all I wanted to talk about. I've given you a couple of case studies that we'll monitor over the next couple of days. That Netflix trade is only a 7-day trade. We're just going to be in it for 1 week. Okay, so I've used options that expire next Friday. Okay, so that's why I really like this type of trade. So long as Netflix can remain under $100, we will keep this credit of $770. Okay. Now, if I look at the return, well, it's a 62.6% return on investment. Now, that's calculated by looking at the maximum risk, which is $1,230, and dividing that by this $770, which is the income that we would receive if we are right on this particular trade. Okay, so we'll see how this goes over the next couple of days. As I said, if Netflix starts to trade above $100, then I'm going to look to close this particular trade. So I always say, know your risk. Know that trading is risky. Only risk capital that you can afford to lose. And always manage your trades according to your plan, and always know your risk in every single trade.